About 20% of properties in the UK are buy-to-let properties, and of those, about 68% of them have buy-to-let mortgages secured against them. So buy-to-let mortgages are without doubt a backbone to the rental sector and a primary tool to helping investors compound their wealth. In this video, I'm going to go through the three main things you need to consider when looking at getting a buy-to-let mortgage. The first thing you need to consider is you need to know if you can qualify for one. Now, it might surprise you that about 1 in 5 buy-to-let mortgage products are available to landlords that don't actually own their own home yet. But with most of those, you do need to have a 30% deposit rather than the usual 20 or 25% deposit. I mention this because a lot of aspiring property investors out there, of which you might be one of them, often assume that you already need to own a home and that getting a buy-to-let mortgage is going to be like getting a normal residential mortgage. But actually, it is quite different. Me personally, I had over £1 million of property investments before I even bought my first home. So although owning your own home and having a bigger salary gives you access to a broader range of buy-to-let mortgage products, the key thing the lender cares about is assessing the ICR, which stands for interest cover ratio, which I'll explain later on in this video. The main thing a lender wants to know from you is usually one, that you hit a minimum income level. So although personal income doesn't play a significant role as it does with residential mortgages, most lenders will want you to have a minimum income of about £25,000 to £30,000 a year. The second thing they will want to know is your employment status. They don't typically care how you earn money. What they're really looking for is that you can prove your income. So being employed or self-employed doesn't matter. They're basically looking for proof of where that income is coming from. Number 3, your age is quite important. The majority of lenders will have a minimum age they'll lend to of 21 to 25. There is also a maximum age limit on many products. So usually the lender wants to be sure that you can actually finish repaying the mortgage by the time you're usually 75 to 86 years of age, dependent on the lender. This is less of an issue for lenders. That being said, lenders are less concerned about the upper age limits compared to the lower age limits. And it's also less of a concern if you're taking buy-to-let mortgages through a limited company, which is another benefit of why buying property through a limited company can be a real plus for you. And finally, number 4, they'll likely care about your credit rating. So although there are specialist products available for those with bad credit, you'll find it a lot easier if you've got a good credit rating. If you're confident on each of those 4 points, you're in a great position to get a buy-to-let mortgage. If you're unsure about any of those points, get hold of a good mortgage broker to see what options you've got, what they recommend, or comment below mortgage broker and I'll introduce you to one. Now you're in a position whether you know if you're qualified for a buy-to-let mortgage or not. The second thing you need to consider is how much can you actually borrow. The amount you can borrow is not going to be based on your income like it would be in the case of a residential mortgage on your home, for instance. It is based on the property itself. There are 2 key things a lender is going to consider. The first, generally, is most people can get a 75% loan-to-value mortgage. So if you buy a property for £100,000, you can usually borrow £75,000. So you'll need the other £25,000 as a deposit. The second thing and main thing a lender is looking at is the rent the property can charge relative to its purchase price. And they do this by working out the interest cover ratio, the ICR. Typically, lenders will be looking for your property's rental income to achieve 125 to 145% of the interest-only loan repayments. So the rent has to be 25 to 45% above the mortgage cost. And they'll usually further stress test this by adding 2% to the actual rate of interest they're planning on charging you, or base it on an interest rate of 5.5%, whichever is higher at the time. So as the basis of their calculations, for example, if you buy a £100,000 property and you want to borrow £75,000, at the moment you can get likely 4 to 5% interest rates. So your interest-only mortgage repayments would probably be about £250 to £313 a month. However, stress testing this to say a 5 1.5% interest rate and then adding the 125 to 145% interest cover ratio would require the market rent to be able to cover roughly £430 to £500 a month. So as long as that £100,000 house you're wanting to buy can rent for more than about £430 to £500 a month, you're likely going to be just fine getting a 75% buy-to-let mortgage on it. If the rent is lower, it doesn't mean you can't get a buy-to-let mortgage, but it will likely lower the amount you can borrow. So rather than a 75% mortgage, you might only be able to get a 60% mortgage, for instance. Finally, the third thing to consider is whether to get an interest-only or capital repayment mortgage. 68% of buy-to-let properties have mortgages on them, and the majority of those are actually interest-only. The main reason comes down to cash flow. By paying interest only, that leaves you with more cash left over each month to either reinvest in buying even more property or use that excess as income to live off. The downside is at the end of the mortgage term, you haven't actually paid any of the debt down. So if you borrowed £75,000, you would still have to pay £75,000 back after 2 years, 5 years, however many years you're on an interest-only mortgage. What most investors will do is keep remortgaging the property as the years go by to make sure they keep getting access to the lowest interest rates available at the time. Whereas with a capital repayment mortgage, your payments will be higher each month because you are essentially chipping away at the debt month by month, so that £75,000 mortgage debt will reduce as the years go by. Neither is right or wrong. It really entirely depends on your personal circumstances and how you want to balance debt in your portfolio. With every property crash, the landlords that have tended to have a harder time have been those that have mismanaged debt. Owning property outright rarely makes anyone bankrupt. However, mismanaging debt often has. See you in the next video.